Hello there, and welcome to the Retirement Step-by-Step video library. This lesson is devoted to being tax-wise during retirement by becoming better tax diversified. Recently, Fred has been spending a great deal of time thinking about and preparing for his future retirement. He has analyzed his Social Security to determine the best collection strategy that will optimize his benefits. He has studied how his employer provided retirement plans can help him transition to retirement. And he has researched investment options for providing sustainable income he will need throughout his retirement. So far, much of his focus has been on ways to maximize his retirement income. But Fred has unintentionally ignored what could prove to be a critically important issue: how much of this income will potentially be lost to taxes. Like many people, Fred has assumed that his taxes will go down once he stops working. But there are several reasons why this has not proven to be true for many retirees. Here are just a few. Many people find that they have fewer tax deductions after they retire. This is often because they have worked hard to pay off their mortgage and can no longer use an interest deduction to reduce their tax bill. Some people are surprised to learn that up to 85% of their Social Security benefits must be included as taxable income. Medicare is means-tested, meaning that premiums are higher for those with greater incomes. This increase could be considered a form of an additional tax. And because it is so common for people to have accumulated much of their retirement savings in tax-deferred plans, such as traditional individual retirement accounts and 401k plans, the spendable amount remaining will be cut because in most cases, distributions from these accounts are 100% taxable. The degree that Fred is prepared to deal with these and other related issues can determine the degree that he is able to enjoy a tax-wise retirement, and tax diversification can play an important role. Tax treatment can be very different depending on the specific type of account and investment. In Fred's case, his savings will be subject to taxes in 3 very different ways, because we will assume he only has 3 types of accounts. Some of his savings will be taxed currently, a portion will be tax-deferred, and some will be tax-free. Fred has some of his money in the form of a bank CD in a non-qualified account. Every year, he receives a Form 1099 reporting the interest earned. He must pay the income taxes on this interest currently, in the year the interest is credited to his account, regardless of whether he withdraws the interest or leaves it to compound in the account. Over time, current taxes can have a pronounced impact on the growth of money. Consider this example. One day, Fred finds a magical penny. The magic? It will double each and every year for 20 years. That means that even though it starts out as just a single penny would, by the end of 20 years, it has grown to over 1 million pennies, or $10,000. This is assuming that nothing interferes with its magical growth, such as taxes. But if we assume that the growth of Fred's magic penny is inhibited each year, even at a small rate of only 10% instead of an ending balance of $10,000, the actual balance would only be $3,759. More than 60% of the potential growth vanishes because of the drag of current taxes and its impact on compounding over time. Fred also has money in a tax-deferred bucket, in the form of his employer-provided 401k plan. The taxation of 401ks, IRAs, and other traditional retirement plans is deferred. All of Fred's money in this bucket will be subject to taxation at some point in the future. It's important to understand that with these accounts, Fred is not only postponing the payment of taxes, he is also postponing the calculation of the amount of the tax, using some unknown tax rate. Since it is not possible to predict what tax rates might be in the future, the calculation of the amount of taxes Fred will ultimately pay can't be determined. If tax rates are up when Fred takes a distribution, it is reasonable to expect he will pay more. If tax rates are down, he will likely pay less. But what is certain is that 100% of this money will ultimately be subject to income taxes, simply because Fred used pre-tax dollars when making all of the contributions to his 401k. Fred has projected that he will have $1 million in his 401k by the time he retires. He had been counting on taking $60,000 annually from this account during retirement to pay his essential living expenses. He is a conservative investor, so his assumption had been that this $1 million would reduce over time because the $60,000 planned withdrawal would likely be more than the earnings or growth he expects in the account. but he is comforted by the calculations he has done because they show that this money should last longer than 30 years. The problem is that when he did these calculations, he was not considering the impact of taxes on his withdrawals. He needs $60,000 per year to pay his essential living expenses, but to net that after what he assumes could be a tax rate of 20%, he would actually need to withdraw $75,000 per year. A 20% tax applied to a $75,000 withdrawal would equal $15,000. After paying this amount, he only has $60,000 available to spend. Fred can see that by withdrawing $75,000 each year, instead of what he assumed would be only a $60,000 withdrawal, his 401k money won't last nearly as long as he initially thought. In fact, Fred is now considering that he might last longer than his money. Fred also has accumulated money in a potentially tax-free bucket in the form of a Roth IRA account. Unlike his 401k where he was able to make contributions with pre-tax dollars, it was more costly to fund his Roth IRA because he had to do so with after-tax dollars. But now that Fred is contemplating retirement, he is glad he has some of his money in this account because qualified distributions from a Roth IRA are income tax-free. Again, Fred calculates that he will need $60,000 annually to pay his essential living expenses in retirement. To fund this, he would only have to withdraw $60,000, assuming that it met the criteria as a qualified distribution from his Roth IRA. Compare this to the $75,000 taxable withdrawal he would need to take from his 401k account to net the same $60,000 after taxes. There are other buckets or ways that money can be taxed that we have not covered. Fred might also have money in an account that receives favorable long-term capital gains or qualified dividend tax treatment, or one containing tax-free municipal bonds. He might have life insurance cash values that can provide favorable tax treatment, or perhaps one with investment real estate. Each of these buckets would have its own set of rules that can impact the taxes Fred might have to pay during his retirement. The point here is not which bucket is the best. Instead, it's that there might be an advantage to being better tax diversified. For example, assuming Fred has sufficient balances in both his tax-deferred 401k and his tax-free Roth IRA, having diversified between these two buckets could provide him with greater flexibility when it comes to deciding how much he might want to withdraw, and when he might want to take a withdrawal from either. With an eye towards possibly managing the amount of taxes he will owe in any given year, he might limit how much he withdraws from his taxable 401k in order to stay under a certain tax bracket, and then take any additional money he may need that year from his tax-free Roth IRA. This might help Fred reduce his tax rate. It could also reduce the portion of his Social Security benefit that is subject to income taxes. As you contemplate and plan your own retirement, you should also keep taxes in mind and consider discussing these issues with your tax professional. That's it for this lesson. Check out the other lessons in the Retirement Step-by-Step video library, dealing with an entire range of subjects to help you better focus on achieving your retirement objectives. Thanks for watching. See you in another lesson.